It's Brian Shannon from AlphaTrends.net. Today is Wednesday, the 22nd of October, 2008, and welcome to another installment of the bear market of 2008. The S&P 500 sold off $5.69 today, or just about 6%, and we see that the little triangle that a lot of people have been talking about we're down to the lower end of that, basically, and we sold off in a little bit heavier volume than what we've seen in the last two sessions. Yesterday I said that the low volume of the last 2 days likely meant that we were coming towards some kind of consolidation, resolution of this range, and that the most likely direction was lower. But we had to see the $93.70 level be taken out as support before we saw any continued downside. We saw the market gap lower below that low and was unable to recapture it, and it was just a series of lower highs and lower lows today. So the primary trend obviously remains lower. Something I didn't point out on this time frame, or for the S&P 500, but I did on the Russell 2000, was this trend line. I suggested that if we started selling off, that we wanted to draw this trend line to see if the potential was there that the market might be finding a little bit of support. And on a closing basis, we did get it. Curiously enough, the volume was pretty light most of the day, but then right at the end of the day, the last basically 10-15 minutes, or 20 minutes, is when we saw the biggest volume, and most of that big volume actually came as the market was rallying here. So it's too early to read into that, but we had heavy volume as the market rallied here in the last 15 minutes or so of the day. The market did remain below that daily VWAP, so the sellers clearly had control for the day, but that's just something worth noting. I think that in order for this market to have any serious chance of upside, we've got to probably at least recapture that 94 level, and probably even higher than that. There's still no reason to be a buyer of stocks in here, and no stocks are safe. In a bull market, they get them all. Let's take a look at that Russell 2000. The Russell 2000 was down 5% as well. Not as much volume in this market as we saw, compared to the S&P 500. But what we're looking at in here was that if the market broke below $52 a share, and it did that on the open as well with that gap lower, then if that level of prior support broke, it had the potential to act as resistance, and from there, that's where we would see a greater sell-off potentially materialize. And this was the market I'd suggested, drawing this trend line in as a potential area where buyers may show up. Not necessarily that you wanted to cover shorts in this area, and not that you wanted to establish new longs, but when you see technical indicators like a trend line or a moving average, and the market approaches that area, or a Fibonacci or anything like that, it pays to look at shorter term time frames to look for evidence that the buyers are showing up. Now, that trend line was hit basically at about $50.50. So that was right here. There really wasn't any evidence that the buyers were taking control, and then we saw that sell off. It did come with volume in here, but the larger volume here came also on the last 15 minutes of the day. It's still below daily VWAP, but it's just a curious little anomaly here at the end of the day that maybe means something, maybe it doesn't. It's too early to say, but it is worth mentioning. Obviously, the trend remains lower. There was nothing bullish about this chart in here, and in fact, it looks quite bearish still. So, still be very careful out there. The gold was down again here today, and we saw the lower low in here. Clearly, this market is broken. You can look at these trend lines. You can look at just the definition of a downtrend, lower highs and lower lows. And as I had defined in my book, the definition of a longer-term bear market is when you have a declining 200-day moving average or 40-week moving average. This is the 200-day moving average. It's declining. This market is guilty till proven innocent, regardless of global headlines and what's supposed to happen. People are liquidating this market, and you have to pay attention to what the market markets say, not what the news headlines say. Because as we know, the case for oil, the hurricanes were supposed to make oil go higher. There were a lot of reasons that oil was going to continue higher back in this area. But when the market breaks down, we have to respect the downside, and this market is clearly still continues to trail below that declining 5-day moving average. The USO was down $4 today, or 6.8%. So even though I said it looks like this area may be where it might find support, there's no evidence of it yet. The market continues to be in a downtrend, lower highs and lower lows. No reason to be long in here whatsoever. Financials, same thing. The bigger level of resistance we've been looking at is basically between the $17 and $18 level. Last week we popped into that range and it was quickly rejected. Then looking at the 30-minute time frame, let's look at the 10-minute time frame actually. What I said yesterday is, basically breaking below $15.25 would then put the $14.50 level into play. We saw the market come down to that level, kind of stabilize in there a little bit. I thought that maybe that would lead the way towards the lows for the year, and those are still reasonable. We still have this pattern of lower highs and lower lows, and a declining 5-day moving average here on the intermediate term time frame, and of course on the daily and the weekly time frame, we've got no evidence of any buying in there as well. So guilty till proven innocent in there. Let's look at the Nasdaq 100. This was the market I was looking at, again throughout the day. And yesterday we saw that the levels of support that looked like they were holding at this $31.70 yesterday were broken late in the day, and I thought that would lead to further downside. That's in fact what did happen. We saw the lower highs this morning. The market gapped lower. It was unable to get back above this prior level of support near 31.70, and I said that basically, even though at this point the market was above the daily VWAP, odds favored continued downside because of the inability to take out this prior level of support. So it's not just about the daily VWAP, but how does the daily VWAP fit into the bigger picture? You can't buy just because it's above the day's average range, and then it failed to make a higher high and get above even 31.60, as you can see here. So I had suggested that basically you wanted to they're breaking they're breaking below this low right here from the morning would likely lead to a move down towards that $30 level. We saw the market did come down towards 30, in fact just under the $30 level. Didn't create a new low, but we saw some buying in there as well very late in the day, and that's where the big volume came in. Look how the daily VWAP dove real quickly right in here. That's because there was so much volume traded below that it dragged the average down. So the market remains in a downtrend. This market's going to have to at least get back above $32 a share before we can consider any counter trend rallies, and it's going to take more time to heal this bear market. Markets correct through time as well as price, and there's nothing indicating that we've seen the worst yet.